We are often taught that debt is a bad thing, and that to be free of debt is an ideal scenario. However, not all debts are created equal. There is such a thing as good debt, and it can be used to your advantage. Being aware of the debt strategies provided in this video and having an overall understanding of leveraging debt can be a powerful tool in any investor's financial arsenal. Debt is very commonly used by the rich to make more money, and we will show you some of those ways today. So sit back and relax as we discuss 5 different debt strategies that can help you make more money. Okay, here's strategy number 1, renegotiating mortgage debt. Since there are so many advantages to this, real estate mortgage debt is the finest sort of debt. Also, you pay less taxes if you have a mortgage. Rich people frequently have many mortgages in order to take advantage of all the tax deductions available. Remember that every dollar saved in taxes is a dollar that can be used to earn additional income. Let me give you a more concrete example, considering that this is essentially how wealthy people become rich and successful in real estate. Let's say you saved $100,000, which seems like a lot of money, but really it isn't. You can't buy a house with that. However, since most lenders require you put down 20%, you can get a mortgage of up to $400,000. Now here is a great strategy used by savvy real estate investors. Suppose you find a property for $300,000 that requires a lot of renovations. You go to a bank and apply for a mortgage with a 20% down payment. So you pay $60,000 and the bank lends you $240,000. You renovate the house for an additional $40,000. You have now spent your $100,000. You visit your bank once more to refinance your mortgage. When you obtained your initial mortgage, the value of the house was only $300,000 because it was dilapidated. But now that you've renovated it beautifully, the property could be worth, say, $500,000. With this strategy, you will refinance your newly renovated house. As before, the bank will lend you 80% of the value of the house. The house being valued at $500,000 means this is a $400,000 loan. So, the new bank loans you $400,000. Now, let's not forget that you owe the original bank $240,000 from your original mortgage, which you must pay back, leaving you with a nice sum of $160,000. You gained $160,000. And now, you have a property you can rent out to build equity and create passive income. In addition, you're going to be able to avoid paying taxes since you are paying mortgage interest. This is a pretty typical strategy used by real estate investors to grow wealth and avoid paying high taxes. Strategy number 2, borrowing goods for sale. The majority of the world's trade is built on debt. In fact, there are some industries where using debt is their best option. Say you want to sell kids' toys. It's a relatively simple product and there's always a market for it. In a normal situation, you would take a plane to China and locate a company that produces that kind of kids' toys at a reasonable cost. You would then buy a container of toys, ship them to the US, and then distribute them to your clients. But nowadays, unless it's a more involved product, most of that is done online through websites like Alibaba. The truth is, you don't actually need to pay for the things in order to get them first. Let me explain how. In the past few decades, China has transformed into the world's largest producer of everything. Thousands of factories operate non-stop to produce everything the world requires. And to facilitate sales, the majority of these factories would be happy to loan you their goods in exchange for payment at a later date. You will need to first establish some sort of trust with them because they won't lend to random strangers. But that's how business is being conducted. After the client sold the product in the US or anywhere else in the globe, he would pay the factory and borrow more goods. You're simply telling the manufacturer that you recognize that they're capable of producing it and you assist them in selling it. If you can sell it for more than the amount the manufacturer wants, you'll make a profit. Selling this way is one of the best strategies you can employ since it allows you to complete the transaction without using any of your own money. Strategy number 3, Forex. A market where currencies are traded is called the Forex market. This stands for foreign exchange. It is the largest market in the world with more than $5 trillion worth of currency exchanges occurring every day. It enables international trade across currencies. However, these currencies fluctuate depending on many circumstances. You can use these fluctuations to your advantage by buying and selling the exchange rates of currencies with the goal that the rate will go up or down in your favor. For example, if an investor uses a Forex broker and buys the Chinese yuan to US dollar currency pair, hoping that the exchange rate will rise, then sometime later, the investor could sell the same amount of yuan to dollar back to the broker at the higher price. The difference between the buy and sell exchange rates would represent the gain or loss on the trade. Now here is where investors use debt, in this case called leverage, to enhance the profit from Forex trading. Leverage is essentially a loan that is provided to an investor from the broker, and the Forex market offers one of the highest amounts of leverage available to investors. The amount of leverage can vary, depending on the size of the trade, but it can be as high as 100 to 1. This means that if an investor buys $100,000 worth of currency pair Chinese yuan to US dollar, they would only need to have $1,000 in their account. If the currency pair goes up in favor of the investor by say 1%, then this would mean that their $100,000 investment has made $1,000. But they only put in $1,000 and yet made $1,000. Thanks to leverage or debt, they just doubled their money. Let's keep going on how to use debt like a rich person. Coming up, we have the simplest explanation you have ever heard about shorting stocks. But before that, we have strategy number 4, credit score. A good credit score is a powerful instrument that can help you make more money using. You see, individuals with high credit score can secure lower interest rates on loans, such as their home mortgage. This leaves them more money in their pockets each month over someone with a lower credit score and higher mortgage interest rate. A high credit score can even mean the difference between the bank allowing you to take out a loan or denying you a loan. People with high credit scores simply get to borrow more money at a cheaper rate so that they can then use to make more money. How can you achieve a high credit score? You have to establish a track record. You can do this by starting small and borrowing small amounts of money on a credit card and paying off the balance each month. Over time, taking out more loans and paying them off on time each month further builds your credit with the recognized authorities. A good tip here is to set up autopay so you never miss a payment. Missed payments can lower your credit score, so they are to be avoided at all costs. Strategy number 5, hedge funds. Hedge funds are created by the wealthy for the wealthy to increase their fortune. They trade in stocks but typically use a different approach that you or I would use. When average people look to buy stocks, they are typically trying to forecast which businesses will expand and increase in value. They then purchase stocks in these companies hoping they will go up. However, hedge funds frequently employ a different strategy based on borrowing stocks and attempting to make a profit when the value of the stocks decline. This process is called shorting. How can hedge funds earn money with debt? Well, let's say you anticipate that a particular stock, such as Boeing, will decline because you know that they have had technical problems with some of their airplanes, and they have not been able to deliver them to their airline customers. You go onto your online broker account and request a loan of one Boeing share. Once you secure the loan of this share, behind the scenes, this Boeing share is immediately sold on the open market. If its value today is $100, you get $100 in your account. At this point in time, you owe one Boeing share to your online broker, and you have $100 in your account. If you wanted to pay back your broker right now, you would have to go out and buy a Boeing share on the open market for $100 and give it to your broker. This would leave you no money left in your account and you would be essentially even. However, suppose you didn't want to pay back your broker right now and instead you decide to wait. Then, let's say that over the next few weeks, the price of Boeing shares drops as you predicted. Say it drops to $70 a share. If you decide to pay back your broker at this point in time, you would go out onto the open market and buy a Boeing share for $70 and give it to your broker, closing out your loan agreement. Now you have paid back the loan of one Boeing share, leaving you with $30 profit in your account. Though this sounds simple in theory, doing it well is quite dangerous and complicated because it could go the other way. Imagine if the stock doesn't fall and instead rises. what if the price doubles overnight? In this case, you would still have to return that single Boeing stock to your broker, but it may now cost you $200 to buy one on the open market. Buying this share now allows you to settle your loan with your broker, but it would leave you with a $100 loss. When you buy a stock, the most you can lose is the money you invested. But when you short a stock, your losses increase as the price rises. This sounds dangerous for an individual, uneducated investor, but hedge funds have mastered this skill and have hundreds of highly sophisticated analysts working for them. They have made fortunes using the shorting strategy. The money building strategies within this video show how the rich use debt to get richer, and they definitely open our eyes to debt not necessarily being a bad thing when used strategically. Mortgage debt refinancing can be a great way to take out equity out of a property so it can be used in other investments to make money. Companies use debt by borrowing products from manufacturers so that they do not have to spend money on buying and storing goods that have not yet been sold. Forex or foreign exchange trading and leveraging debt can also be used as a means of investing by using currency exchange rates to take advantage of market fluctuations. A great credit score can open the door to new lines of credit or loans and gain you access to lower interest rates on your debt. Hedge funds use debt to borrow stocks and pay them back later when the stocks are worth less, netting them a profit. Of course, not all debt is good. Debts with high interest rates such as credit cards or loans tied to depreciating assets should be avoided. However, hopefully this video has shown you a few ways where debt can be used carefully and strategically to make your money grow. We hope you enjoyed this video. If you want to see more, check out our other videos below.